The number one question that I'm asked on a daily basis that's on the top of every home buyer's mind right now is, will the Federal Reserve cuts make an impact for mortgage rates to move lower? Let's dive in. Here's the market as of right now. Quick refresher, if you follow me on any type of social media, when you see red, even though that's a small candlestick, let's use this for example, red on any given day is interest rates trying to pressure higher or get worse, and green is interest rates trying to improve or go lower. So just like any type of investment, if you flipped it to a chart view, these candlesticks represents the activity on the day, and the mortgage-backed security in the bond market is what drives mortgage rates. So as you can see here in the last week, interest rates have been holding steady. This is a good sign. And since the July 2nd, interest rates have been on an improving pattern. However, they've kind of flatlined. Why? Everything is pointed to next week. Next week has a ton of information coming out, but from here on out, the two most important things that the Federal Reserve is watching is anything to do with jobs and anything to do with inflation. So on Thursday and Friday of next week, we have two things that are very important. One is the initial jobless claims, the GDP, gross domestic product, that's overall. But the jobless claims is it moving higher? We're going to get a report today that did say on June 8th or July 18th that jobless claims did move higher. So that's another indicator that jobs are showing weakness in the jobs market that will lead to the unemployment data. On the inflation side, they're watching the consumer price index, the core, the producer's price index, all of these, the personal spending, all of these factors is, does the consumer still have money to spend? That's the biggest thing. And right now, middle class America is shifted. What's shifted with middle class America is the analysis is showing that middle class America is looking for deals. They're no longer just spending just because what they want, they're spending because of what they need. That's a big shift from just what's happened through the course of this year and last year. It was a lot more what I want to spend on rather than what I need to spend on. Now everything's getting very dialed into the need, because why? Inflation has moved so high, and the cost for everything that you and I pay for has moved so high. Groceries, everything, right? Gas. So now it's what we need, and now that frivolous spending has come to a slowdown. So that's going to have an impact on the economy and start to slow things down. So what does this mean to the Federal Reserve, Keith? Well, if we look at the future of the Fed rate hike or Fed rate cut, this chart is a real-time analysis of Fed futures. And right now for the July 31st meeting, it's showing a 95% chance that the Federal Reserve will not cut. However, let's jump ahead to the September 18th meeting. That just moved to a 93% chance of a cut. So this is anywhere from a quarter to a half. Well, I guess it's a quarter across the board, excuse me. So if you look at here, the 500 to 525, 525 to 550, right? So it's a quarter basis point cut. So why is this important to mortgage rates, and why is that important to the future of this year and going into 2025? Well, in U.S. history and economics, you could simply Google this. You can Google the Federal Reserve rate hike history or Federal Reserve rate cut history. Either one's going to bring you to this, and it's going to take you to this page. And what I want to point out is, you look at, let's focus on hikes first. Well, we all know what happened when they started to hike. You go back to March of 2022, they started to hike. Why were they hiking? They're trying to control inflation from going out of whack, right? So cost of everything started to move higher, and we all know where that led us till today. But look at the amount of hikes that they had to do and the amount of each hike. So you can see it's not every month consistent, but they are having to do things because they're watching the economic data come out month after month. So here's a future of hikes. Here's a history of the cuts. So we went from 2019 in August to March 16th. They had 5 cuts. First 3 were a quarter. And then you can see in 1 month, they moved 150 basis points or 1.5%. So whenever you see these rate hikes or rate cuts, what does this mean to me, Keith? Well, your credit cards, your variable interest rates, everything that's variable just took a move higher. Your home equity line of credit, all those things, your interest rates, you look at the statements going, holy cow. And that's why credit cards now are crazy to say, almost tipping 30%, right? So they're in the mid to high 20s. So all of these hikes led to that type of increase in interest, and that's because of inflation. So it's not a recession that they're predicting for the future here. It's disinflation. So the key thing that I wanted to point out that the media and what you're seeing on social media does not tie together is in U.S. history, there's never been just one hike or one cut. So since we are predicting that the first rate cut that the Federal Reserve is going to have is in September, well, if they make that first cut, that won't be the only one. So if they make a cut, we're probably going to have potentially one more, because again, if we look at November and December, it is predicted that they do have another cut. And in December, we possibly have another cut. So in these three Fed meetings within 4 months, we could see that we could have that potential momentum. I'm not going to go into 2025 because that's just too far out right now. But the key thing is we're looking at is once they start a cut, there is the future showing that there are more cuts cutting. Again, it's all driven by economic data, so that's going to be watched incredibly closely by the Federal Reserve. But this shows the prolonged nature of interest rates moving lower. So what does this show? If, let's hypothetically say, if here was the cut, it's going to take time for those mortgage rates to move lower and react. But the key thing is it is going to move lower for the future, because that's what happens in an environment where the Fed's cutting interest rates to control disinflation to what? Avoid that recession, right? They're trying to create that soft landing so we don't go into recession. The Federal Reserve has been notoriously accused of being too late to take action. So it does feel like this time they're running on pace. Some are saying they're a little bit late, but in my perspective, personally, from my 2 pesos or whatever it's worth, it feels like it's coming at the right time. And coincidentally, let's chalk it up to this. It is an election year, and that's in November. Hopefully this helps. If you have any questions, please leave in your comments. Send me a DM. But this is where the future is going. I'm very excited because this all is going to help the housing market for the buyers and for some of the sellers that are stuck at those very low rates. As those rates begin to ease through next year, getting into those mid to low sixes and potentially starting with the 5, it doesn't hurt as bad when you have to give up a rate to move, to sell your house, to come off of a rate that's maybe in the 3s or possibly even the 2s. In the 4s, it definitely softens the blow. Let me know if this helps. Thanks a lot.